I'll press stream. Okay, we're good. Okay, hopefully after that, once again, that's slightly testing introduction there. There's a few issues that we had with the streaming software, so hopefully we're good to go now. But all good. Anyway, here we are, and thank you all for joining. There's a few people in the room, which is great to see. For people who are going to watch this on a recorded basis, shame you couldn't join us for the questions, but obviously, thank you for taking the time to watch it if you do watch it. So anyway, look, we're back in the gold market. Interesting time. If you haven't read about what's happening in stagflation, that's the buzzword at the moment. We are seeing slower growth in Q3. Specifically in the US, we've seen Morgan Stanley downgrading their growth. Goldman Sachs have done the same. We've seen the Atlanta Fed coming out with their model, suggesting that US is currently running about 3.6% GDP. The sell side consensus around 6%. We're seeing sticky inflation forces. If you look at 5-year, 10-year break-even rates, 5-year forward rates, all the kind of market-based inflation expectation guide, they're all fairly heavy. So this word stagflation is really manifesting itself into asset prices at the moment. We're starting to see a weaker picture develop across Asia today. And I think the market is trying to understand this dynamic between what could be us talking ourselves into a 5% correction in the S&P. You've got to keep an eye on that 50-day moving average on the S&P. That's your big one to watch. And can we see ourselves talking ourselves into a correction? What does that then do to bond markets? What does it do to the US dollar? So I think these natural correlations that we're seeing between, say, gold and real rates and the dollar, they're all sort of moving around. And obviously the thing that we look at most closely when this is obviously how the market's aggregating its price action. So we go straight to the charts. Let's have a look at dollar gold. Last week we talked about this level of resistance around 1833. Well, look, it smacked it to the T after the payrolls number came out. Obviously, everyone really focused on the idea that wages were significantly stronger than what people were looking for. People were saying that a lot of the one-off factors that are sort of playing into that weak payrolls number on Friday are going to dissipate. I'm not so sure that's going to be the case. I really do not believe that this idea that we're going to see a snapback into the September payrolls, which comes out on the 8th of October, is necessarily going to happen. But what do we see in the market? Well, we got up to this the level that we were looking for, mean reversion shorts. That seems to be working relatively well, as you can see there. We've broken this channel support. We've been making a series of higher lows and higher highs on the daily chart, as you can see. We smashed through it earlier in the week. Really, well, I say a big move. It was down 1.5%, but given the volatility in gold, a 1.5% move seems to have hit us pretty smack bang in the chops. And that's where we are at the moment. We saw a little bit of indecision, a bit of a selling into this 5-day exponential, and then we're back into this supply zone, or the bid zone that we've been seeing here. For people to get an understand about movement or expected movement coming through, Adnan, I've definitely touched on some currency pairs, but I'm going to focus straight away on gold. What I like to do is I look at the distribution of outcomes that are based in the options market. The great thing about the options market, which I get my options pricing from Bloomberg, is that the whole thing is based on movement and expected movement and math, effectively. So you can see what the market's pricing in terms of movement. I've put a couple of these numbers on there. So for a break over the next week, I've used weekly implied volatility here. So this is not what's happened, it's what's happened. And they're also taking a forward-looking view at implying the expected movement in an asset up or down. So to get a break above this 1833 level, which we can see is really clear resistance in this market. The market's putting about a 7% chance that we're going to get up above that level over the next couple of weeks. Well, next week, should we say. So we do know this is the key level now. So if we can get a close above that level, then obviously we're going to start bull trending. We thought that was going to be the case last week when we got to move through this supply zone, which probably would be more pronounced if you take the time frame into an hourly chart or a 4-hour chart. But we got this failed break that played through here, and obviously a rejection off this resistance level here. But to give a bit of context for people who are saying, look, I'm going to go and buy on a break. We love buying strength. We love selling weakness above 1833. Well, the market's saying over the next week we've got about a 7% probability of that playing through. we're back into this zone. We've obviously broken the uptrend that's played through. Does that mean we're going to see an all-out collapse? Obviously, there's no guarantee that's going to be the case. I think usually when we see trend breaks, we tend to see a bit of a move lower, and then we tend to see markets sort of moving and chopping around sideways a little bit. But this is your key level now. So your support that comes into at 1780, and you can see these bids that have been coming into the market. Obviously, if we can chew through those, then you may see a bit of a more pronounced move. I think once again we are in these kind of changing dynamics where you've got a focus on real rates, a focus on the dollar, and obviously we're just looking at trying to understand exactly why we buy gold and why people are going to continue to push prices higher or lower in one direction and cause trends. So I'm again sitting in the camp at the moment that we tactically play this one as mean reversion trades. We're selling into strength, we're selling into weakness. And again, we look at straddle pricing, the straddle pricing off the at the money straddle. And really for anyone trying to understand this, for people looking to buy and sell volatility in the gold market or any kind of market, to give you an understanding about the break-even levels, 1813 down to 1765 is your area at the moment where the market is saying with near 70% probability that we trade into 1830 over the next week or 1765. So this kind of region here, the market is saying nearly 70% of outcomes should be contained within this price. We've also got to move there. So I think anything above that level probably would be a level that, unless the news significantly changes, we see a big pickup in volatility and the dollar starts trending in one direction, then I think that the way that I would be looking to trade this over the next week or so is to continue to focus in on this area here, and any kind of strength up into those upper bands is an area that we'd be looking to sell into, and through these kind of levels would be an area that we'd be looking to buy. We'll also we obviously like to use a confluence of different kind of oscillators and indicators. And you can see that the RSI, I've got a 14-day RSI, so a bit slow moving, but we can see the 14-day RSI sitting around 50 at the moment. So it gives you real conviction that this is a mean reversion market. So what we can do is, of course, we can put Bollinger Bands on this. Bollinger Band taking a 20-day moving average, we've got a 2 standard deviation. This is actually a 1 standard deviation move, but you can see that the Bollinger Bands, which captured effectively 95% of outcomes through those bands, they look a little bit optimistic to me, and you can see that that's obviously based on a 20-day period. So those Bollinger Bands are narrowing as we speak. You can see that realized volatility is coming in. So I'm not so sure we'd be looking at that too closely, but I think those are coming in, and they'll probably come back into levels in the next day or two, which will be good, probably mean reversion levels to look into. Keltner bands are another one that sort of feed into my idea about what's going on. The settings that I like to use, which I'm going to change now, I like to use a 20-day period. I like to change the average ATR down to a 5 period, and I like to use a 2 multiplier on that as well, so 2 times ATR. And I think that again is probably what I would be looking to do. Probably for next week, I'd like to back test this one to give us a sense of where we're going. But Keltner bands are another situation that you can use alongside Bollinger bands, and I've used implied volatility, which you can see here. But yeah, again, the Keltner bands are giving us a situation where we look to sell strength and look to fade weakness as a trade. Obviously, I'm talking short term here. I'm not talking about what's going to happen over the next 2-3 months. I'm talking about what's going to happen over the next week and how I would trade that. So I continue to like selling strength into around these kind of 1825, and I like to buy weakness below 1764, which sort of feeds nicely into the Keltner band. That's what I'm going to be doing on the week. I'll be looking to probably take profits back into this 1800 level. Because everything at the moment is markets are trying to really understand exactly what's going on with the world. That said, we also need to react, and if we do see a break of both these levels and it continues to trade on, I reckon we could start seeing some trends, and that would obviously need to be respected. We adapt and we change as traders. Right now, my bias is to trade that range, but if we did start seeing it, starting to range trade, then I would be looking to go along. But my bias at the moment is to continue to use whatever indicator you want to use. I'm using implied volatility, but you could use Keltner bands, you could use Bollinger bands when they come in as the guide in that situation. Let's have a look at what's going on in the currency markets then, because let's have a look at that dollar situation. Well, the dollar's an interesting one. Let's just take this take the counterband off because obviously the dollar index is a big reflection of the ECB, and I can see that 56 parallel has talked about the ECB meeting. Yeah, I think it's a big one tonight. What I'm going to have a quick look at is euro dollar overnight implied volatility. So what I like to do in this situation is really get a sense of whether the market is seeing the ECB meeting as a volatility event. And you can see here that we've just pushed up to 9%. So this looks at the expected movement in overnight options. So this will be encompassing what we're seeing in the ECB meeting. So it has pushed higher, and it's certainly trading at sort of, you can take this level that we got back in November. If you took that out of the equation, we'd be trading into sort of the 90th percentile of that 12-month range. So you can definitely see that when we look at options and what's implied in terms of movement, up or down, people are starting to price in movement. We can divide that by 15.9, and that would effectively give us what people are expecting in terms of movement as a percentage there. So you can see that people are expecting the ECB meeting to be a bit more of a volatility event. So I think for people who are trading the euro or gold trading in euro, you can see that it is starting to trend lower. You can see that people are running short euro positions, or at least have pared back some of that positive euro exposure. We've got this big double top in play there. Obviously, the neckline right down at 116.63. That is, well, I can imagine if we get down to there and that double top neckline is breached, then, that puts a lot of downside in euro dollar. But what does that mean? Well, I think the ECB meeting is going to be interesting because I think the asset purchase program, the PEPP program, I think there's a pretty good chance that they're going to take that down in terms of the run rate there of bonds that they'll be purchasing, and they'll change their language about buying substantially more. The question is, of course, for us is as macro traders is we know that kitty expires in March of next year. Will they look to top it up? Will they give it a new increased envelope, should we say? Or will they allow it to lapse and obviously some of the funds then go into a new program or the other program called the asset purchase program, the APPP? I think the ECB will be pretty cognizant not to allow German bunds or Italian BTP spreads to widen too sharply and see a big move up in the euro. We know that the ECB are generally quite dovish, but you can see here that the market is paring back some of that long euro exposure into the ECB meeting, despite them apparently tapering their bond purchase program. Our clients are generally short euros going into this as well. I mean, certainly in euro yen and euro sterling, they're running short euro positions into this. And again, if you go into the dollar index, you can see it's traded into the 50% retracement level of this move back down here. Market sharply rejected, but you can see some buying coming through, and obviously that's a reflection that Asia seems to be under a bit of pressure. The Chinese have come out and pushed a couple more measures against Tencent and a couple more of the gaming stocks, and Hong Kong stocks are under a bit of pressure. That's taken a bit of wind out of the Aussie dollar as well. I mean, the Aussie dollar traded in this nice range. We saw this big move down. We're back into this range. Had the failed breakout. We're moving a little bit lower. So I think short positions in Aussie dollar look quite good at the moment. So what does that mean for gold in other currencies? Well, I think the dollar's looking strong. Therefore, if we are going to see a downside break, you really want to be short gold in the strongest currency, which may well be the dollar on the day, and that may take us a little bit lower. We do need to chew through these bids coming through here, and I think if we get that break back down into these lows that I talked about a minute ago there. The Aussie's looking weak, so I think if in an environment, if you want to take long positions in gold, we really want to do it in the weakest currency. Is that now the high beta plays, the high beta FX plays? Maybe that's the case. So you can see Aussie dollar starting to trend. If it starts selling off into this 5-day exponential moving average, and it keeps respecting and it makes these lower lows and lower highs, I'd be using that 5-day exponential to guide this into the 50-day or 100-day, should we say, and then maybe a little bit lower from that point there. And maybe therefore, if we, if I was going to take a position in gold, you want to do it in the weakest currency, and therefore we offer a Pepperstone different currencies to look at. I do like to look at, the yen on a trade weighted basis. I think the yen's a really good proxy of risk appetite. We can have a look at other things like optionality and the expected movement and people's hedging flows and other those bits and pieces. But you can see the trade weighted Japanese yen had a bit of a pullback here, but now it's starting to see a few buyers there. So if the Japanese yen kicks up, I'd imagine we're going to see some safe haven flows. Maybe that does actually boost the gold price. We'll have to see. But yeah, I think the Japanese yen on a trade weighted basis could be quite an interesting one there as well. So read a couple of questions. We covered the ECB meeting. Can you tell me where I can get a currency strength meter indicator? I've not seen a currency. I mean, obviously, you can look at oscillators and various factors. I know in the futures market, there's some really good tools to look at. We can look at positioning as well. I mean, positioning is always interesting. If you look at the CFTC report, manage money, these are futures positions, and as I look at net length, you can see that, yeah, it's still sort of just going really nowhere. The market's still net long of gold, but it's not really any kind of extremes, and that's been something that we've been talking about recently as well. Have a look at real rates. These are 10-year tips. Effectively, these are nominal treasuries have been adjusted for expected inflation, and this has been such a big driver of gold. And you can see, we know that gold has no yield, and therefore, if you see the real returns in the bond market becoming more negative, you can see it's trading at negative 105 basis points. Then gold effectively becomes that store of value that everyone sort of cliche talks about. So when we're trading down at a negative 120 basis point, gold was looking pretty perky. We've come back to negative 100 basis points, and people were saying, "Oh, gold's going to start selling off a little bit now. The dollar's going to strengthen," and but then it sort of just pulled back a little bit now. So I think if this does kick up and we see the rate of change tick up, then I think gold probably trades to the bottom end of that range that I talked about, the 1773 level. But yeah, I mean, it's no go. And again, it comes into this idea that we've got these very choppy dynamics playing through. You've seen what's happening in the dollar price, but real rates are still pretty low. Both of those combined together make us go, oh, actually, what does this also mean? Peter, currency strength meter on TradingView. I haven't seen that, so I'll definitely check that out in the short term there as well. I use FinViz for currency strength and weakness indicator. Yeah, okay, cool. I've not heard that one either, to be honest. There's a million ways you can identify currency strength or any assets in terms of strength and the strength of the trend, whether weak hands are there as well. The trends that you do see in FX markets tend to be much more short-lived than what we see in the equity markets. I mean, obviously in the S&P, we've just sort of so used to watching the S&P futures. If you have a look at S&P futures here, you can see there really every time it goes into this 50-day moving average, the buyers step in. Now we're coming to OPEX week, options expiry, and that tends to be a bit of a weaker period in the market. But you can see this is a beautiful trend there, and pullbacks into the 50-day where everyone seems to be buying. I think there are risks that we pull back into there again. Whether we continue to hold that level is obviously yet to be seen. We could be pulling back into the 100-day, but yeah, there's a beautiful uptrend playing through in the S&P at the moment, and therefore you tend to see people, continuing to buy pullbacks in there. The system's really set up to go long. Whereas in FX markets, we are seeing some trends. You see some trends quite often in dollar yen and Aussie yen and all those factors, but they tend to be much more mean reverting, much more short term. You need to be quite cute with your positions. Anyway, so back to the gold price. Next week, as we go into the week, there will be all eyes on US CPI numbers. We know that the Federal Reserve are looking, or at least stipulating that they're looking at the labour market as their guide for tapering. Although we did hear from Robert Kaplan this morning from the Dallas Fed saying that he probably sees that there's going to be a slightly weaker jobs number in September. There's no guarantee it's going to be stronger, something that I talked about earlier. But he still believes that. Milan have not enough software. Well, I'm not sure what you mean by that. Please view on Cardno. I think that's one actually that's getting set up on the platform fairly soon. I disagree. We haven't got enough software. CTrader, MT4 and MT5, and you can pretty much download any indicator that you want, or E-Trade. I think that's reasonably conducive, and I think at some stage we'll probably be on TradingView as well. So I'm not sure if I agree with that comment. Where was I? Sorry. Yeah, so CPI next week. I think we're going to see another big CPI number print coming, and that's obviously going to impact the rates meeting ahead of the September FOMC in a couple of weeks' time. And yeah, I still believe that we're going to see the Fed taper probably November, December, probably sort of leaning towards December at the moment. And that could have big impacts on markets, especially in this idea of slowing growth. Tapering into slowing growth could be the reason why we're going to see slightly higher volatility in markets. What does that mean for the gold market? It's difficult to say. We could see lower real yields, which is good for gold, but at the same time, we could see a stronger dollar because of safe haven flows playing through on the dollar smile theory. So I think that's why we're seeing the gold market moving sideways. We're saying to ourselves, what does this stagflation mean for the dollar? What does it mean for volatility? What does it mean for equity markets? Could we be seeing this 5% pullback? What does that mean for the bond market? And they're trying to understand these relationships that seem to be sort of breaking down. I think probably the closest thing that you're going to see for gold is what happens in the currency market. So if the dollar strengthens on a broad basis, obviously gold prices will probably trade down through these lows. So yeah, I think these are the sort of situations that we're using, that we're seeing going through in the market at the moment. Of course, when you're trying to aggregate all of these factors into one thing, price is true. That's what price is doing. It's aggregating all the behaviors, all the intel that you see at any one stage. And right now, while we're trying to make our mind up, it still leads me back to this one view that I've got, that in the short term, I'm range trading the price, looking for moves above 1870, over 1820 to look to fade in the short term, and any kind of moves back down into between below 1765 for long positions, and see how price trades that. So as always, I hope everyone has taken something from this. Please leave some comments below, and yeah, if you found yourself liking this video, please obviously do that. And yeah, if you've got any comments, love to hear them. And obviously, this is a great forum to sort of share views around gold. So please do share them going forward. So thanks everyone, and hopefully see you next week.